What's up, YouTube? In this video, we're going to break down the 5 biggest reasons why your investments aren't growing, or they're not growing as much as you want them to be growing, or maybe you're even losing money right now. This is one of the biggest challenges that I help a lot of my clients and students tackle, and I think it's really important you understand why this is happening to you. Before we dive in, quick intro if you don't know who I am. My name is Jose Hernandez. I have an online financial education company that serves first-generation wealth builders, people like you and me, people are the first person in their family to start investing or start thinking about investing. And my mission is to help you learn how to invest for your goal of financial freedom or building generational wealth for your family. Got my start in the financial industry as a wealth management advisor, where I earned my Series 7 and 66 licenses, work with wealthy individuals, got some of the top mentorship from some of the top financial advisors in the industry, and learned everything hands-on that I've been sharing on the internet for years now, and have gone on to serve thousands of people in your shoes. So let's go ahead and dive into today's video. Like I said, we're going to be covering the 5 biggest reasons why your investments aren't growing right now, starting off with the fact that you're simply just following the wrong investment strategy. So this is investing 101. The mix of investments that you own, which is called your asset allocation, is the biggest determinant of how much your money is going to grow or not grow, or how much money you're going to lose depending on your strategy. So this is just a quick review. There's different types of strategies that you can be following. And again, the types of investments or asset classes is another word for it that you own. That mix is what's going to determine, are you following an aggressive growth strategy? Are you following more of a conservative strategy that's focused on protection? And where I've seen a lot of people go wrong with this is they will be following a more conservative approach, meaning that they're owning maybe more bonds and cash than stocks in their portfolio. And that approach could be fine if you already built enough wealth and now your focus is on protecting that wealth. Maybe you're already retired and living off your investments. But if you're trying to grow your wealth from scratch, like many of us here are, you have to take some risk. And people hear the word risk and they think incorrectly about it, because risk is inherent to investing, but you need to learn how to take risk responsibly. Because if you just own quote unquote safe investments, meaning investments that really don't fall too much in value, sure, that portfolio may not drop a ton when the market drops, but you're also not going to capture a lot of the growth of the market long term, which is of course the point of investing. So as you can see here in this chart, we have a mix of different types of investment strategies that are determined by the different percentages of the different types of investments that you own. A real life example I see of this somewhat often is in employer 401k plans. Maybe you signed up for your 401k years ago and you chose a default option. In a lot of cases, that's like a target date fund. And with target date funds, they're designed to mirror an approach that makes sense for the specific year that you choose. And sometimes that default option is like, just doesn't make sense. So for example, let's say like you're 30 years old and you're currently in a target date fund that's like a 2025 target date fund, which is basically assuming you are retiring in 2025. So that portfolio is going to be super conservative because we don't have that much time between now and then. And you're going to be primarily in bonds and cash versus stocks. So of course, you're not going to capture a whole lot of the market's returns because you're being so conservative with your investment mix. So that's really important. It's investing 101, but in a lot of cases, it's just not having the right strategy based off of your expectations. Again, if you are growing your wealth from scratch, you don't have to necessarily be ultra risky and super aggressive if you're not comfortable with that. But you do have to have some exposure to the market. Otherwise, your money's not going to grow as much as you need it to be growing right now. And this is another just chart that visualizes the relationship between how much your money can grow and the amount of quote unquote risk that you're taking. Again, risk is just a way of thinking about the mix of investments that you own. So by definition, the more stocks that make up the percentage of your portfolio, that includes index funds and ETFs, the more aggressive and more growth oriented you're being with your portfolio, and vice versa. So that's mistake number 1. Mistake number 2, excuse me, is that investment fees are killing you. I've seen this often as well. I'll give you a quick story. This is someone that I was working with one-on-one, one of my clients, and he was working with Edward Jones. Not to knock Edward Jones. I'm sure there's plenty of good Edward Jones advisors out there, but that was not the case for my specific client. And what was crazy was, when we went through onboarding and started looking at his stuff, he was like, man, I've been investing regularly in my Roth IRA and my other accounts with this Edward Jones person, and my money has not grown. And I've been investing in it, post the COVID pandemic, where the market's been up a good bit. And he's like, my returns are flat. And I thought, maybe you're looking at it the wrong way, or maybe you're looking, you don't understand your account statements. But when we took a look at it together, he was right. the market was up a good bit during that period of time, and his returns were literally flat. So we did some more digging into why that was the case, and it was really a combination of two things. One of them being he was just being put into really lousy investments, and secondly, those investments had a lot of fees tied to them, had a lot of commissions, front-end loads, and also high expense ratios. And he was able to learn how to get out of that situation and learn how to invest on his own. And it's a really great story because since then he's been able to grow his net worth to over $1 million. And this is just an everyday person, just like you and me, really hardworking person. He's earned that success. But this is a clear example of how investment fees can really kill your investment performance. I have another video that goes into investment fees in more detail, but just to know what to look for in your investments, specifically with mutual funds, if that's what you're investing in, there's the front load or back end load, which is basically like commissions that you're paying when you're buying or selling investments. And then there's the expense ratio, which is like basically a percentage of the returns that you're giving up every year for owning that investment. And both of these can really add up over time, right? So it's really important to pay attention to. And just another quick story. I've shared this before on the channel, but this is from Simon, one of my first students that I brought on after moving on as a financial advisor. And he literally discovered that he was on pace to paying over $1 million in investment fees because he was being charged 1.75% in his portfolio. And he got the confidence and knowledge to be able to take control of his investments and finances. And he's well on track to building not only a lot of wealth, but also saving a ton in investment fees. So moving on to mistake number 3 is you're simply inconsistent with funding your investment accounts. And this is extremely important to understand if you are building your wealth from scratch as a first generation wealth builder, because I see a lot of people think that investing is like, I'm trying to pick the next Amazon or the next Google. I just put in a little bit of money and, I'm going to become a millionaire overnight. And that's not how this game works, because the truth is there's really 3 primary stages to your investing journey. I share this with clients and students all the time. And this first phase is called your accumulation stage, which is again where you're building your wealth from scratch. And the number one thing to focus on in this stage of your investing journey is simply building up your portfolio's balance. And yes, compound interest does work to a degree in this stage, so it's not like you don't get any compound interest, but it's really important to do the heavy lifting yourself at this stage, because you have to put in the work first before your money can start really doing the work for you. You might have heard that old Charlie Munger quote saying that the first 100,000 is you know what. And that's really important to understand, because if you think about it, let's say, for example, you get a 10% return on $1,000. That's $100. If you get a 10% return on $100,000, that's $10,000, right? So it's the same percentage return, but because you have more money invested, you're getting much more money from your money, basically. And in this early stage, it's really about consistently funding your investment accounts and, of course, making sure that money is being invested and not just sitting in cash. But where I see a lot of people go wrong here is they're trying to just, every once in a while put some money into the brokerage account or into the Roth IRA or whatever, and trying to like chase the next meme stock or the next, 100x play or whatever they're seeing on social media. And of course, it never works because that's not a high probability of success type of strategy. So this is what it could look like to set up your finances to be systematized to where you're consistently paying yourself first and investing on a regular and continuous basis. This is an example for a business owner. It applies whether you're a business owner or not, but essentially they have the business profits that flow through to the business bank account. This person probably sets himself up as an S corp and pays himself a reasonable salary. So part of that money is going towards their personal bank account, and some of that money is being divvied up into their investments, maybe their high yield savings accounts. And also on the business side, they can have it set up to where maybe they have like a business retirement plan, like a solo 401k or SEP IRA, and money's automatically being invested and put away there. And of course, still making room for everyday wants and needs, mortgage, rent, utilities, and so on. But the key here is understanding the best thing that you can do at this stage is to really make sure that you are systematizing your finances properly to where you're putting the money to work consistently and automatically as well. So that's reason number 3 why your investments aren't growing. Reason number 4 ties into reason number 3, and it is you are gambling instead of investing. So a lot of people think just because I'm buying certain stocks or putting my money into certain types of investments, I'm investing. And let me help you understand. There's a very clear difference between gambling and investing. This is a quote that I share with clients and students all the time. Basically, it says, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. So the premise here is good investing is actually pretty boring, right? It's not something that you should be treating it like a FanDuel account, or, you're not doing Sunday parlays out here. You are building consistent long-term wealth. And this requires a different type of approach and mindset compared to, day trading or trying to find the next meme stock or meme crypto or whatever it is. There's a big difference here because the reason this is important to understand is when you're taking just insane amounts of risk, whether it's a little bit of money or even a lot of money, you're sure the upside is high, but what a lot of people don't realize is successful investing isn't just about how much money you can make. It's also about how much money you don't lose. And when you set yourself up to take these high risk plays, you're setting yourself up to really lose a lot of money if you don't get it right. And the concept that I'm showing you here is one called portfolio drawdown, which is just a fancy way of saying, how much your portfolio drops in value. And the key here, especially as your wealth continues to grow, is to limit the impact of these steep losses in your portfolio. Because number one, they take time to recover from. And secondly, it's really hard to recover from some of these because what a lot of people don't realize is the more percentage loss you take in your investments, the greater percentage return that you need from that point in time just to break even. So for example, a 10% return requires an 11% return from that point in time to break even. A 40% loss requires a 67% return to break even from that point in time. A 50% return requires a 100% return to break even from that point in time, and so on and so forth. So for example, losing 70% requires you to gain 233% from that point in time. And this is how people fall into that gambler's mentality of like, I just need that one next big flip, right? I just need that one big play. And it's almost never going to happen to you. So I just want you to understand, if you've been losing money, this is probably one of the biggest reasons why. And then number 5, you are investing without a financial plan. Now, this is something that a lot of people don't think about, and it does become more important the older you get and the more wealth that you build, because what I always tell people is a good financial plan is really like a GPS for your money, your investments, and your future. What a good financial plan does is helps you understand you're at point A, where you are right now, with your current finances and investments, and then you're trying to get to point B. Point B being that future goal of financial freedom, maybe generational wealth for your family, early retirement, whatever that end goal is. A good financial plan helps you understand what are the steps, step by step, that I need to be taking to reach said destination. Just like a GPS tells you, hey, get on this road, take this turn. If you miss that turn, get back on this route, et cetera, et cetera. And how this ties back into growing your investments is it helps you stay on track. So think about it like if you're getting into a car and you're just trying to drive to a certain destination that you've never been to before, but you're not using GPS, it's probably going to take you forever to get there. And it's the same approach, same type of mindset when it comes to your investments. So what a good financial plan looks like, and this is just a quick screenshot from one of the clients that I'm working with currently, it outlines what your goals are. It outlines the different accounts that you have. It outlines how much you need to be investing in said accounts. It outlines how much growth you need to achieve in the different accounts. It outlines how much what you need to be doing to save in taxes, et cetera, et cetera, et cetera. So a good financial plan is precedent. It's important, especially as either you're getting older and you're running out of time to reach that goal, or as your wealth grows and it's now time to really start being strategic with the money that you currently have invested. So that's point number 5. Now, if you're watching this video and you're like, man, I'm really struggling with my investing, I'm serious about my goal of financial freedom or building generational wealth for my family, I'm doing my best, but I just cannot seem to figure this thing out, what you can do is in the description to this video, you're going to see a link that you can use to schedule a one-on-one conversation with me. This is the type of stuff I do all day, every day with clients and students. And I'm happy to have a conversation to figure out what's going on right now, see how I can point you in the right direction and make sure that you are on track. So again, the link to that is going to be found in the description to this video. But that's going to be all for this video today. I hope you found it helpful. If you did, make sure you give the video a like, drop a comment down below. Make sure you subscribe to the channel, but I appreciate you taking the time, and I'll see you in the next one. Thank you.